Everybody's learning everything about what's going to make them more money. And I said, this isn't going to make you more money. This is where you put your money so that you have it to use again in the future. This isn't you know, some kind of miracle policy that's going to, make you money. You've got to capitalize first, and you've got to take time to let it grow before maybe you can invest in something that will give you passive income.
Gina, thank you so much for joining us today. And just let's start off with just tell us a little bit about you and how you discovered the infinite banking concept and becoming your own banker.
I had heard Nelson talk many times at a seminar for Money Tracks years ago, and he would be selling his books, right? This is the first book I purchased. And probably 3 years it took before I realized that I really need to read the book. But what happened was I got an invitation from another colleague here in Michigan that had Nelson out. And I thought, well, that's weird. Why would he send a life insurance agent an invitation to one of their dinners? And so I called him up. It was David Cobb. And I said, David, I'm an insurance agent. Why would you have sent me this invitation? He goes, I want insurance agents to be here. Insurance agents need to know more about this. So myself and my colleague, Deb DePillo, went to the seminar in Grand Rapids for 2 days. And by the end of it, he had told me that they're going to be having a think tank probably the next month. And I was so excited to not only see him, but I laugh because that's the date. I don't know if you can see that. That's his signature on the book, April 28th, 2007. That he signed my book, and I said, can I come to the think tank? And he goes, yeah, you're welcome to. We want everybody. So I signed up, and from then on, I've been come to the think tank since 2007. I think I've missed a few, some of the more important ones due to travel and things of that nature. But Nelson has been a big part of my career since 2007. And I use his book quite regularly. I buy them all the time, ask people to read them. In the beginning, I would sell them for $20 to the individual, hoping that they would read the book. But I found whether I sell them or I give them away, those who want to learn more will learn more and will read the book and will follow the instructions. So behind me, if you can see this advanced capital group board that I created for a seminar Nelson did May 30th, 2015, it says up there. And we had registration and a 15-minute break and a whole day. We didn't do 2 days, we did 1 day. And I keep on here as my memorial, really. So this is the, trying to keep it up there. A couple of my pins. I have a lot of Nelson Nash pins, but this is also his thank you note from his funeral that I really regret that I didn't attend, but I'm very grateful that I've been to his gravesite and give honor to a man that has touched my heart and many more.
Yes. Thank you for sharing all that. Is there any particular story that you have with Nelson that just, that you always think about or and makes you laugh or, anything that he meeting with a client or, any kind of story that you can share about your time with Nelson?
Yeah, I have had Nelson out here, I want to say 2 times in Flint. This was a Saginaw event that I had for clients. That was probably the best event that I'd ever done because these 2 physicians found the book in Saginaw and it had my name in the book. Every book that I get, I put a sticker in, Gina Wells, my name and everything else. So they called, and they've been longtime IBC clients since then. But the one time I had him in Flint, we went to the Flint Farmers Market, which is just a little cute, quaint bistro for coffee. And of course, in lunch, and Nelson orders a cup of coffee, and they bring him a cup, and it was an Auburn University cup. And he looked at the cup and he looked at the waitress and he said, do you know who I am? Where I'm from? And we laughed so hard because then he just, talked to the gal, and she had been, from Alabama at one point. And so it's kind of funny. This little coffee area in Flint, Michigan had an Auburn University coffee cup. So that was a funny story.
Yeah, huge alumni network there, huh?
Yeah.
Yeah. Yeah.
He was always so joyful. Mary, when Mary would come with him to all of the different events, we always had fun going out to dinner and getting them into their hotel and from their airport back and forth, and just had really good conversations and learned a lot about them during that time.
He was really a people person, right?
Yeah.
He always wanted to just get to know everybody he met, and find out where they were with their, not only with finances, but just their life, right? So he was truly interested in people, and he kept up with them too. That's something I haven't figured out how to do, but he was always good at keeping up. I mean, if he's doing a seminar in Flint, Michigan, he would find out who he knew en route to Flint, so he could divert and visit them also. So
Well, he certainly did, and a couple of times we had people come into my office that he wanted to see, so we, met here. But just different insurance agents that were not a part of the think tank at that time, or now the Nelson Nash Institute, but that he just wanted to keep his connections with. It didn't matter that they were members or not members. He just wanted to talk with them and see what their life was like, and reminisce.
So you talked about becoming your own banker in the book and how if you've sold them, you've passed them out, and I love that tip about having a sticker in it with your contact information. What is your favorite part of becoming your own banker?
I always use the twin sisters story all the time to talk about the difference between a CD and a cash value life insurance. And I used to love listening to Nelson tell that story. And I wanted to also talk about the rule of five. I should have wrote that down because that's another one of my stories from Nelson that has really stuck to me, that I learned a lot from. But I always use the two twin sisters. Well, you're doing the right thing. You're making money on yours, and you're not making any money in the life insurance policy. How dumb are you to be purchasing this thing? And I use that story, and I continue on because we don't know what we don't know. And it's definitely the human factor of lose it or use it or lose it. And so that one is always one that I go to. I've always used the grocery store. Why is it that a can of peas that costs 30 cents and to replace them is 33 with a margin of 3? And that kind of rolls in what I believe to the rule of 5 as well. Everything in Nelson's book to me either revolves around a 10% move or a 5% move. And when the government gets involved with the rule of 5, right, then that cost of living that should continue to go up over a certain amount of period of time gets interrupted when a third party comes in and says, "Oh, well, your hospital room is no longer $30; it's $3,000. Your hotel stay is no longer." So I mean, it's little stories like that that I'll use, and I use a little bit of everything because I always sit back and listen to who I am speaking with, right? And I can tell when people have read the book and when people haven't read the book. Recently, I had a referral come in of a pastor who's been, again, all over the internet, and I see this more and more. Everybody's learning everything about what's going to make them more money. And I said, this isn't going to make you more money. This is where you put your money so that you have it to use again in the future. This isn't you know, some kind of miracle policy that's going to, make you money. You've got to capitalize first, and you've got to take time to let it grow before maybe you can invest in something that will give you passive income. But, reading Robert Kiyosaki, he's talked to other I don't think practitioners, infinite banking gurus online, and he just wanted illustrations. I want a 70/30. I want a 60/40. Well, what do you want that for? Well, I want to see what it will look like, as they all look the same. Right? How much did you put in? Is the thing, and how much can you put in? And so I think people forget that, and kind of bring it back 10%. If you have gross income and you tithe 10% and you save 10% from a young age, you're going to do really well later on in life. But the longer you wait in life to save money, the more that you're going to have to save to even be able to live on what you think you can live on. And so it's just a reality conversation with a lot of people because everybody's out there looking for the next best thing that's going to make them a bunch of money. And, unless they are an entrepreneur themselves and a real estate guru or, something of that nature, they really just need to focus on saving and reusing their dollar more than once by utilizing the policy.
Yeah, the key word here is what uninterrupted compounding, and that's the beautiful thing about this product. And you're not spending cash, and you're not depleting the uninterrupted compound aspect of it. You know, so the policy loan is really a misnomer. It's really an insurance company loan using the cash surrender value as collateral for that. That's the beautiful thing about it. Like you said, you can save money, you have a death benefit, and you have readily available access to cash through these loans. It's beautiful. So
I just read the highlights of Mary Jo's podcast just recently, and I should read it so it's correct. But basically, what she said is a policy loan doesn't make you money, it's the interest that you turn back into premium that builds up the policy. And I think a lot of people miss that too. They think that just taking a policy loan, their policy is going to grow. And no, your policy is going to do what it's going to do, whether you have a loan or not on it. You're borrowing from the insurance company, and they're going to give you profit as a dividend if you're participating whole life insurance on that whole of all of the money still on the compounding curve. It's when you borrow from the insurance carrier and you go do something with that money. Is it making you money that you did something with, or are you doing it to pay off a car? So you're paying yourself back. And now you're the banker, so you're going to determine the interest rate you pay yourself, the deposits over time that you're going to pay yourself. And that's making that payment back, if it's just to the policy loan, is not going to get you further ahead. May not even save you in interest, right? But at least you're not using the banking system. However, that's where paid up additions come in, is that you can add some of that additional payment that you might be able to make back to yourself by buying paid up additions or even a brand new policy 10 pay, right? Everybody, that's another issue, do you buy 100 pay? Do you buy 10 pay? Do you buy a 5, and it really, your first policy, in my opinion, should always be 100 pay, because you should always be paying that policy for that period of time. And then when I'm helping clients to take a loan to buy a car, for example, and I say, did you get new money because you have more income? Or is this the same car payment that you had in your budget all along? And if it's the same car payment that they had in their budget all along, a lot of times what I'll do on the payback, if I can't add up paid up additions, I'll let them see a 10 pay that's maybe a $25,000 death benefit if it's a low payment, 100,000 if it's a big payment. But the point is that you can stretch out your payment back to the first policy and the second policy and build more cash value and more death benefit with one car payment.
Mm-hmm. So do you actually handle clients' loan repayments, or they just train them how to do that on their own?
Back when a lot of the old infinite banking people, and I'll use Ray Poteet. I learned a lot from Ray. I'm sorry that he's passed away. Very unfortunate. But I learned a lot from Ray and working with Nelson back in the day. And we were to have a schedule of a payback, and that you should always be making sure your clients are doing all of this. And I did that for a while, but I came to realize that, people always live a life. So now that sometimes they can't make that payment, and that would happen a lot. And they'd call back, oh, I got to change this payment. I don't want to deal with that. So I would always say, keep in the bank account, your checking account, that what you need to pay your normal bills. And then when you see you've got extra money, send in $100, send in $200, send in $25, send something back that you're not going to use that month to pay back your policy. So it used to be I was pretty stringent. This is for this policy loan and that's for that policy loan. But I've come to realize it really doesn't matter. Get the money back in the policy when you have the money to get and pay yourself back. Mm-hmm. So that's where I'm at today.
The central part of becoming your own banker is the human factors. And so I keep going back to that because every conversation leads back to what you just suggested. How do you think about this? How do you handle your policy? Are you helping the situation or hurting it? Do you really understand what this is about or not? Do you understand the problem and do you understand the solution? And if they get it, like you talked about, the light bulb goes on with those two doctors. Man, when they get it in a big way. And I think the human factor thing is more important than the insurance part of it. To tell you the truth, because that we always go back to that. It's always about dealing with human tendencies and human behavior. So
Our
that's
belief systems,
yeah,
right?
yeah,
Our belief systems.
yeah.
And I still to this day, and I don't disagree. I mean, I have clients with a 2.5% mortgage or something. That's a pretty good deal in this economy. You do have to think about what other banks you're using and for what reason. But when I get someone who says, "Oh, my rate of return I can get on this Capital One money market is 5% right now, so I want to keep my money in the Capital One money market at 5%." And then I go, "Well, let's talk about that. What is that 5% going to do for you? Are you saving to spend it? You know, are you saving because you want to pay tax on the interest and not realize that you're not getting 5%, you're getting 5% less your tax bracket when you give the government some of that money?" And you've really lost control because you don't have any leverage on that. You pull that money out and it's not earning for you anymore. So, yeah, we need to talk about all of those pros and cons of each account that's out there, 401k, matches and things of that nature. Um, all of that comes into what I call a 360-degree approach when I talk with clients about where all their money's at. Um, I don't just say, "Oh, do you have $50? Let's put it in life insurance." "Oh, do you have $100?" I don't. I want to be working with people who are serious about their money. And I talk to people who really aren't serious, like the referral that I was talking about, right? And he's serious about his money, but he's starting way too late, um, and he doesn't have the right frame of mind, right? To save first. This has to be a miracle cure where I'm going to put my money. No. You know? It's not
Yeah.
going to be a miracle cure. But yeah, I want to know their saving habits, their spending habits, and work with them to build better saving and spending habits. And understand, like all of my clients know that I ask them, "What is your big purchase number?" If you're going to purchase something over 2,500, over 5,000, or 10,000, right? What's your big purchase number, and what are you going to purchase it for, right? And I have them write it down. And I remind them, okay, so you had 5,000 in, I'm going to use 5,000, 5,000 in a bank savings account. You pulled it out as a down payment on a car. Now, not only do you have a car payment, but don't you need to repay yourself back so that money's back, so you have 5,000 back in your savings account when the car goes bad, 5 years from now? And that's the automobiles and purchases like that are easy for me to explain the infinite banking because you got to make a deposit on a car. Then you get a car payment. Then your car is worth, 1/3 of what you purchased it, maybe 1/10, depending on how long you have it, miles and all of that kind of thing. Then you got to buy another one. So there's always that vehicle, and that's always a good thing to talk about because people seem to get that. There's always a payment plan in their head.
Yeah, that's why Nelson in the book, when he first did his seminar, he talked about big numbers, and for financing homes and stuff like that, and it just went over everybody's head. And so he downsized it to a car payment, to financing a car, like and just so it would be something that the average person can get their head around financially. Yeah, I can afford that. Yeah, now I understand how this concept really works. So yeah. So
And I use software to help them see it, right? But not everybody sees the calculators the way that I see them, right? I'm trained to use them, right? But other people are like, "What did you just do?" So you have to go back and kind of get people to even understand how an amortization table works. That's not something anyone is taught or even cares about. All we know is that we have to come up with 350 or 750 or whatever the number is per month out of our paycheck. And that's where I try to help people to realize that it's just not a payment out of your paycheck. It's lifestyle choices that you have to make and decisions that you have to make with not looking at tomorrow, but looking at 30 years from now, hence our rules to think long term. And that's another thing that I say quite often is you need to think long term. You're thinking short term. And I'll remind them that they came back to short term. Let's think 30 years out. If you keep doing this and you keep paying for a car, how much will your money be 30 years from now? Again, you'll have whatever the value of your car is because all you've done is recirculate your money that way. And so we'll even pull out, 20% of a car payment. And then I'll say, even if you earn 0%, you're going to wake up 30 years with cash and a car, right?
It's very clear and very obvious the way that you're talking that you care a lot about the clients really understanding this concept. And how have you seen the infinite banking concept impact your clients' lives?
Oh, well, just this morning I had a meeting with, and I know I can say his name. Can I could, but if he'll watch it, Tim. I won't use his last name. He lost his wife about 3 years ago to just, I mean, the Lori was my age, and she ended up with a cancer that took her life within 7 months. Lori and Tim were probably, I want to say maybe 8 years difference in age, Tim older. So it was always that we were protecting Lori, from Tim's death, so that Lori would be able to live the lifestyle that they've created. Well, it turned out to be the other way. And so there was a bunch of money that came in through death benefit. And we sit down every year and go through this, and he'll say, Lori, you always said go talk to Gina. He'll sit here and talk to Lori while he's here in my office, and we do. But it made a big impact because he didn't have to worry financially. What happened after a totally unexpected interruption of his life, right? I mean, they were to live their life together forever. And, Lori was supposed to outlive him, as he'll always say. But now he's started banking. His two daughters are started policies, and they're starting their whole because they've seen it, right? So as the parents see it, now that's a terrible story to talk about death that was able to get their daughters started because they didn't really have, jobs per se, but they had a blended marriage, such as my husband and I have. And so their children together, Lori wanted half of her death benefit just to be for those two girls, right? And because the other two children were from another marriage and they were doing very well. His two older children are married with children and doing very well in their own lives. But my point being is that it will filter down if it's taught to be filtered down. Um, uh, in a situation with a death. Another client, an, we used to do once a year meetings with the family, but things have changed a little bit where now I'm just meeting with the family individually. It's hard for everybody to get together because everybody's everywhere. Um, we don't have the benefit like Jason Lowe. A lot of people don't to go, hey, let's get on a cruise ship together. That doesn't always happen, right? But as long as everybody's talking about it and, having a conversation at least once per year about where things are going and how to use a policy um, and how to build on it, it's really how I've kept my business afloat. I've been in business for 30 years, but I've been practicing infinite banking for more like 20, I guess. And I've done a presentation for the think tank years ago that I didn't even know I was doing infinite banking when I bought my first life insurance policies, when I was 22. But yeah, so it's just meeting with people, talking with them at their level, listening to what they have to say, and trying to help them build a better future for themselves. And that's kept me in business from referrals and families. And when I say 30 years in the business, you can see I'm into the next generation of my first clients. So it's great to be doing that as well, seeing young people saving money.
That's a good story. Yeah, it's I talked to a lot of practitioners, and the ones that have been doing this for a while, they say the same thing, that they're floored about the majority of their businesses is referrals or generational referrals or just additional policies for their existing clients, because they get to the point where they can't use them as much as they need to now. As their wealth grows, their portfolio, their policy portfolio grows with it, so they can continue to run their cash flow through these things. So it's you know so I always wonder, I'm not in production, but everybody's different. But I was wonder, if the primary focus of a business, an insurance business, is IBC. I mean, how many clients can you service, individually? I'm just, because it seems like a lot of work, right? To
I measure it this way. I send out 200 calendars every year right now, right? And every year I add, maybe 10 or 20. I don't really add a lot of clients to my business every year, maybe 10 to 15. But it's because of where I focus, right? I'm looking for, I don't like to, at this point in my career, do $100 a month policy, right? I'd rather give that to somebody else who wants to do $100 a month policy. I mean, my average case size is probably a minimum of 20, maximum. Well, I've got 250,000 premium out there now. So, and that's just because of who you're talking with or whatnot. And I don't like to level it on that. In fact, coming back to Tim this morning, he's like, I talk to other people and they go, I'm doing so good in the stock market. And what are you doing? And he'll say, I've got my money in life insurance and annuities. But that doesn't make you any money. And Tim's like, well, it's made me money. I'm doing well with it. And I showed Tim on one SPIA that I wrote years ago for him. It's a 13% return on his current balance right now, a payout, right? Distribution. He's in the distribution. SPIA is a one-time payment and it gives lifetime income. As we know in Nelson's book, it's the furthest. It's like the paid up additions. It's like a mech policy, so to speak, but it's not death benefit. But when it comes to talking with people about what they want, and I get the SPIA, the life insurance, um, it all just kind of melts together. So Tim's like, well, how do you get paid? I said, well, Tim, I got paid when you bought the SPIA. I got paid when you bought the life insurance. I get renewals on those. Those come in. And I do, have a business of assets under management and retirement income planning with annuities, right? So if I looked at my business is probably 90% whole life and 10% annuities and other things that come in. But those are all what I call ancillary to the purpose, right? The purpose is, you've been with me, Tim, now for 20 years, right? 25 years. I've got other clients that have been with me for 30. Why is that? Because I give them service. I help them make decisions with people who have passed in their families, estate planning, real estate planning, tax planning, all those kind of things. So, David, when you did look at all the different, American College has got quite a bit of my money over the years, but I just started with the RI register retirement income certified professional, RICP. I always get confused with more letters behind my name. But what does that mean? It means that I've studied, I've learned what kind of laws are changing out there. As an insurance agent, you're always having to take continuing education. So you're always trying to educate yourself on what's happening out there. One of the biggest things I think that is changing is the inherited IRA. When we think of the amount of money that's going to be transferred to the next generation, currently is as much as our deficit, right? Our the debt wall, the debt clock that goes on. That's how much money. I mean, you could take all the inheritance and pay off the debt, would be done. But that's not going to happen. Those inheritances are from qualified plans, right? Because that's what the government knows where that money is at. Those qualified plans are going to come to the next generation, who is either going to go, oh, I have to take this off over 5 years minimum and not know what to do with it, or they're going to liquidate it all in 1 year and pay a bunch of tax. there's a lot of issues that are going on with that right now. And to focus on teaching young individuals what can be done with what they have to take out, right? Are you going to take it out and spend it and put it back in the market? Are you going to take it out, put it in a life insurance policy and be able to have that kind of money tax free when you retire, passive income tax free? Let's look at the both sides of the situation here and just have a conversation about that. But that's, I think, something that is also needed to be talked about to the next generation who stands to inherit this kind of money.
I look at it kind of the same way with life insurance policies, with transferring a mature policy, transferring ownership to the next generation. That's seed money to start their own policies or continue their policies too, you know. So, and non-taxable use of that is an important piece of it, even though IBC is not a tax design program by any stretch of the imaginations. There is a lot of inherent tax advantages to the whole life product. So in the IRAs, you're talking about the 5-year distribution schedule, restricted schedule. You know, you talk about liquidity. I don't think so. You know, a lot of things that are not explained about those qualified plans, I don't think. But, you know, the important thing from your perspective is you have all the licenses and the qualifications to actually dive into that stuff, where, you know, you have the knowledge and the credentials and the ability to talk about all those things and help your clients navigate those different assets too. So that's important.
So, Gina, you are an authorized IBC practitioner. What inspired you to have yet another credential, take another course to join this community?
I think a lot of what is taught in the practitioner program helps people understand the dynamics, the economics of a whole life policy to really dissect what it is. But I also want to come back to what Nelson used to always say, it's ridiculously simple, right? I could take a Truth Concepts payment calculator, and I explain this a lot to people on a death benefit. If you wanted to accumulate $100,000 over 20 years, right, how much would you have to save at 0%? And 20 into, 100,000, and that's what they'd have to save. Well, life insurance gives you a discount on that. And they'd look at your mortality, and it's your age and how healthy you are and whatever, and how much longer are you going to live. The longer you're going to live uh, at a, let's say, 3.5% discount interest rate over 30 years is going to get that payment lower, right? Instead of 0%. And so I help people understand that about the death benefit. It is ridiculously simple. It's you have to put money into this to have money, right? 20, 30 years from now. And if you die 3 to 4 years into it, it's a self-fulfilling prophecy. Here's what you were supposed to have 30 years from now, and your family gets it tomorrow. No questions asked. Here's the check. Now, what you do with that, if that happens, is the next thing, right? Because people always think, well, am I going to get another life insurance policy? Is that policy going to be the same life insurance? No, you're going to get a check and you're going to have to do something with that money. And so there's some misunderstanding there that people don't understand about life insurance, is that it pays out at death. You get a check, and you have to figure out what you're going to do with that, whether it is to supplement your income or whether it's to go, okay, I'm still working, I really don't need this, so I want to start new policies on myself. And there was a podcast not too long ago about convertible term insurance. I use a lot of convertible term insurance because people don't understand that they're going to be, could be, maybe, uninsurable in the next 20 to 30 years. But they're going to need that death benefit to buy the next policy. And God forbid it's the person who owns a term policy that passes away, then their spouse, if working, should have at least half of that amount so that they'll be able to take that money and put it away. And so make a policy out of it. So I think a lot of times just getting to understand term insurance from whole life insurance, term insurance that's convertible, I get people who will go, well, what about that return of premium term insurance? I could get all my money back if I pay a little bit extra. And so again, I just use calculators to take them back and go, you have a handcuff on all that money you stuck in that return of premium policy. And oh, by the way, you got to wait 20 or 30 years to get the check, right? It's a big amount of money in there. So again, coming back to human factors, liquidity, use, and control of your money. Um, don't wait too long to start saving. Parkinson's law, uh, all of those things come into play. And then, of course, with the the IRAs, how people misunderstand that they're postponing paying tax today to pay it into the future. And I'll have people who will come in and they're really in a 5% net federal tax bracket because they have 3 or 5 kids and they've got tax credits. And, you know, I'm like, you're postponing 5 cents on the dollar to pay it at more than likely 40 cents or higher on the dollar by the time you retire. And they go, I never looked at it that way. And guess what? They stop contributing and move that money.
Well,
But
I guess the big question is, why didn't they look at it that way? You know, what are they being taught? What is everybody else doing? What is what do the powers that be want them to do with their money? That's the big question.
that's the
And
soundbite financial planning.
yeah, yeah.
I also have a client who was the manager of a business, so I run one 401k program for a company. And the only way that I can get to talk with the individuals about what they're doing outside of this 401, and by the way, there's a Roth, so all of them are putting money into the Roth. There's not anybody that's pre-tax in this business. They're all putting their money into the Roth. And of course, the employer is matching, they have to match into the pre-tax. And so I explained to them that employer match is always going to be taxable one day. Your Roth won't be. This isn't really enough for what you need in the future. Let's make an appointment and talk about your overall savings outside of that. So that's also been another unique way to get clients, right, that I'm still servicing on that. And now more and more are starting to listen. In the beginning, people are living paycheck to paycheck, especially, making under $50,000 a year. There's not a lot of money to go around. And so as they make more money or as they grow, and I've been servicing this 401k for probably 8 years. So now those people have been saving, they see it. Some have taken loans from the 401k to help them, get out of other debt that they had. But now more and more are starting to see the benefit of planning outside of just the employer benefits. And I think that's the problem right there, is they think the employer benefits are the end all be all, and they're really not. They're one piece of the puzzle.
Gina, thank you so much for spending time with us today and sharing some of your personal stories from your time with Nelson over the years. And your passion for your clients is very evident. And, as we wrap up, I just want to ask you, what does the infinite banking concept mean to you?
Well, I call it I'm sorry, the Nelson Nash Institute now. I have not used infinite banking as a term for quite some time because of so much noise. And I have a wonderful picture of Nelson when he would wear these noise canceling reduction headset, is what he would call them, and put these earmuffs on to stop all of this other craziness out there. I belong to the Nelson Nash Institute because the infinite banking concept can be done with anything outside of a whole life insurance. I mean, it can be, but why doesn't it work? Economically, it doesn't work. Economically, you cannot measure the benefits of a dividend paying whole life insurance policy to doing infinite banking with a bank account, infinite banking with a universal life policy or an index universal or a variable universal life. There's all these costs, right? So you have to actually put more money back in for any other product than dividend paying whole life insurance when it comes to repaying policy loans, because you have, even though your interest rate may change, you have a fixed premium going in. So if the interest rate did go up 5%, well, guess what else is going to go up? Your dividends, right? And I often tell the story about E.F. Hutton When E.F. Hutton spoke, everybody listens, back in the late 70s, early 80s. And what did E.F. Hutton say? You are idiots to be buying whole life insurance. You're getting 5% where you could be getting 15 and 18% in these new products. Buy term and invest the difference. And people would get rid of their whole life, had gotten rid of their whole life insurance to put money into a universal, only to wake up 30 years from now to find out they had nothing because the cost of the insurance bankrupted their policy. So again, that was short-term thinking. Long-term thinking, the rule of five, right? Just get 5%. And I don't know, David, did the rule of five really also kind of come out of the rule of 72? You know how the rule of 72 says you divide what rate of return you're getting, and that's how long a number takes to double. And so you think with whole life insurance, on average, it used to be 5. Now it's a little bit lower. But 5 divided into 72 is 13 years. So every 13 years, your first premium doubles, right? I don't know if Nelson had that in the back of his mind too with the rule of 5, besides the commissary story with bananas didn't change. You know, things of that nature. Chicken didn't change, but I think chicken and bananas have changed recently with government intervention. The cost has increased inflation wise, but I would rather say the Nelson Nash Institute because I'd rather pay homage to who taught me how to do this, who coached me how to take this policy and explain it to people in simple terms, right? This is not rocket science. We could, all of the fun things that Nelson used to talk about, keep it ridiculously simple. Yeah, I'd say I'm a practitioner of the Nelson Nash Institute, and I understand all of the and use Becoming Your Own Banker as a book. But when somebody talks about infinite banking concept, there's so much noise out there that I cut it off. I don't talk about infinite banking concept anymore.
Well, thank you so much again, Gina, for joining us. We really appreciate you.